Michael Burry warning. What's coming is worse than a recession. Do you remember the chaos of 2008 when the housing market collapsed and the world was plunged into a financial crisis? It was a time of uncertainty. But one man saw it coming. Michael Burry, a name that became synonymous with foresight, predicted that crisis and made lots of money and profit when many doubted his judgment. Fast forward to the present day, and Michael Burry is once again sounding the alarm. He's not just talking about another recession, he's talking about something far worse. A Wall Street crash by the end of 2023. The stakes are high, and the implications are vast. In this video, we're going to delve deep into the factors driving Burry's latest forecast, understand the bold prediction he's making, and, most importantly, learn invaluable lessons that can help us weather the storm. But who is Michael Burry? Born on June 19th in 1971 in San Jose, California, his journey is nothing short of extraordinary. He overcame early challenges, including the adversity of losing an eye to cancer. He studied economics and pre-med at the University of California, Los Angeles, and even earned an MD degree from Vanderbilt University School of Medicine. However, he didn't complete his residency in pathology at Stanford University Medical Center because, during his free time at night, he was busy working on his passion for financial investing. After finishing medical school, Burry worked as a resident first in neurology and then in pathology at Stanford Hospital. But eventually he decided to leave the medical field to pursue his own hedge fund. His talent for value investing had already made him well known in the finance world, thanks to his successful stock picks, which he often discussed on message boards at the stock discussion site, Silicon Investor, starting from 1996. His knack for choosing winning stocks even caught the attention of major companies like Vanguard, White Mountains Insurance Group, and renowned investors like Joel Greenblatt. Back in the year 2000, Michael Burry made a bold move by establishing Scion Capital. It was the starting point of his journey into the world of value investing, a path that would later lead to one of the most remarkable predictions in the history of finance. Scion Capital, under Burry's leadership, wasn't afraid to challenge the status quo and defy the financial industry's prevailing narratives. What truly set Michael Burry apart was his meticulous analysis of mortgage-backed securities. While the financial world was riding high on the housing market's success, Burry's keen insight uncovered a fragile foundation beneath the apparent prosperity. He saw the risks that others ignored, leading him to make a courageous prediction. The housing market was headed for a collapse. Burry's analysis led to an unconventional move, betting against the prevailing narrative and purchasing credit default swaps as a hedge against the looming crisis. But it all wasn't smooth sailing for Burry. During his journey, he faced an investor revolt, with many questioning the accuracy of his predictions and demanding to withdraw their capital from his fund. This was a true test of Burry's courage and conviction. He remained steadfast in his belief, and history would eventually prove him right. The outcome was astonishing. Michael Burry personally made a profit of $100 million, while his remaining investors enjoyed more than $700 million in profit. Scion Capital achieved returns of 489.34% between 2000 and 2008, a stark contrast to the S&P 500's modest return during the same period. Fast forward to August 2023, and Michael Burry is at it again, making headlines with his bearish predictions. This time, he's taken a massive short position against the S&P 500 and NASDAQ 100. In a move that has grabbed the attention of financial experts and investors, Burry's Scion Asset Management purchased out options worth more than $1.6 billion against these major market indexes. In recent Securities and Exchange Commission filings, Michael Burry, through his fund Scion Asset Management, has taken a strongly bearish stance on the S&P 500 and NASDAQ 100. He has invested $866 million in put options for a fund linked to the S&P 500 and $739 million in put options for a fund linked to the NASDAQ 100. Notably, Burry is dedicating over 90% of his portfolio to these bets on a potential market decline. So, how is Burry making these bearish bets? Well, he's using a strategy known as put options. A put option gives the holder the right to sell an asset at a predetermined price, even if the asset's market value plummets. In this case, Burry's put options are like insurance policies against the market going south. If the market crashes, he can exercise these options to sell at a higher price, protecting his investments. Burry's concerns go beyond just placing bets against the market. He's been vocal about several key factors that are driving his bearish outlook. First, he sees a speculative bubble forming in the market, particularly in high-growth technology stocks. This excessive speculation has led to inflated valuations, making the market vulnerable. Moreover, Burry is worried about inflationary pressures caused by central banks injecting massive amounts of liquidity into the markets. He fears that this could erode the value of assets and disrupt the market. Burry also points to the rise of passive investing through exchange-traded funds, which he believes is distorting stock prices and creating a false sense of stability. Another element in Burry's prediction is his concern about the alarming levels of corporate debt. Over the past few decades, the world has witnessed a significant surge in public debt, reaching unprecedented levels. This growth has been fueled by various crises, posing a real risk to the financial system. Now, let's dive into the world of economic indicators, starting with the Shiller price to earnings P/E ratio. Now, I know this might sound a bit like financial jargon, but it's actually pretty straightforward. The Shiller P/E ratio is a barometer for the stock market. It takes the average earnings of the market over the past 10 years and adjusts for inflation. When this ratio is high, it is a sign that stocks might be a tad overpriced. It's like seeing a price tag that makes you do a double take, and that's a red flag. Because historically, when the Shiller P/E ratio is high, it's often followed by a market correction, or worst case scenario, a crash. So, when Michael Burry talks about this ratio, it's not just fancy numbers. It's a warning sign that smart investors pay close attention to. Next on our list is the impact of political uncertainty on financial markets. Now, this is a big one because politics and economics are like close cousins. When political situations get rocky, financial markets tend to get jittery. Think about events like Brexit, trade wars, and international tensions. These can stir the pot and make investors nervous. When there's uncertainty about how governments will handle these issues, it can lead to cautious investing and even a loss of trust in policymakers. That's a red flag for market stability because it can affect consumer and investor sentiment, which in turn can undercut economic growth. Now, let's talk about the growing wealth gap. This is a topic that's been making headlines. We've got the wealthiest 1% accumulating wealth at a much faster rate than the rest of us. Now, this isn't just an issue of fairness, it's also a concern for market stability. When the wealth gap widens, it can put a drag on consumer spending and overall economic growth. You see, when a smaller group of people control most of the wealth, it means that a lot of folks don't have as much to spend. And when consumers are cautious, businesses can take a hit, leading to market instability. One of the key lessons that we can learn from Michael Burry is all about diversification. You've got to spread your investments' wings. Just like a chef's spice collection enhances their culinary prowess, diversifying your portfolio enhances your financial prowess. It's crucial for success. Don't put all your eggs into one basket. Spread your investments across different sectors, asset classes, and geographical regions. That way, you're not putting all your financial eggs in one basket. If one sector takes a hit, the others can help balance things out. Lesson 2, the rule of the crash reserve. Picture this. Your emergency funds are like a fortress protecting your financial well-being. To fortify this castle, keep your emergency savings separate from your regular accounts. Don't let the temptation to withdraw funds easily sabotage your financial stability. If possible, stash your emergency funds in a different bank, adding an extra layer of complexity to accessing those funds, discouraging impulsive actions. And don't forget to review your emergency fund periodically to ensure that it aligns with your evolving financial circumstances. Lesson 3, invest in stable industries. Just like building a house on a solid foundation, investing in industries that can weather economic storms is a wise move. Think about sectors like utilities, consumer staples, and healthcare. They offer essential services and products that people need, regardless of the economic conditions. Companies in these industries tend to be more resilient during market downturns, making them a reliable choice for your investments. Lesson 4. Embrace Michael Burry's contrarian approach. Burry's success isn't just luck. It's a result of meticulous research and a willingness to go against the crowd. He doesn't rely on gut feelings or hearsay. He drives deep into complex financial data and uncovers hidden patterns. It's all about the attention to detail and the ability to cut through the noise. So remember, when you make your investment decisions, tap into your inner researcher, get into the nitty-gritty, and don't be afraid to challenge conventional wisdom. If you enjoyed this video, guys, make sure to subscribe to the channel, like the video, and watch this one as well. Thanks for watching.